For our viewers worldwide, a very good morning. I'm Menace Crenny in Dubai. Vonnie Quinn alongside me in New York. Welcome to Bloomberg Brief. Let's set that agenda.
Bracing for a no landing. Short-end Treasury yields recalibrate the Fed's ability to deliver cuts. 1 year on, tensions mounting in the Middle East as Israel ramps up strikes a year after Hamas's October 7th attacks. And back to the table, Boeing and its largest labor union return to wage discussions after 2 weeks of stalemate.
Vonnie, a very good morning to you. We're recalibrating all the way around. Equity markets are really grappling with this punch higher on the yields. Max Kettner at HSBC says still go aggressively long here, aggressively overweight equities. We are recalibrating, as I said. Mohamed El-Arian talks about a liquidity dominance. You're going to get big banks reporting this week, JP Morgan, Wells Fargo and BlackRock. But I take you to ground zero of a very big recalibration. The short end of the curve, twos are now up 28 basis points in the space of 2 trading sessions. This is about trimming back the view on what more the Fed will do. 10-year government bond yields are above 4% for the first time since August the 8th. So again, this is about a market which is retethering or re-anchoring itself to 50 basis points, maybe by the end of the year. And there is less than a full probability of a 25 basis point cut in November. So we are discussing what no landing means, and would the Fed run the risk of skipping in November, as has been mooted by a number of houses. James Lord is the head of FX and EM strategy over at Morgan Stanley. James, good morning to you. Good to have you with us both. We're now at an 80% probability of only a 25 basis point cut in November. This market is recalibrating. Do they keep the insurance cuts alive?
Yeah, I mean, we're expecting to see a 25 basis point rate cut at each of the last 2 meetings from the Fed. I think it's going to take a lot for the Fed to skip a meeting. I think you're going to need to see a lot more concern coming back in about inflation. And I'm just not sure that there's enough time really left to see the kind of data that will give the Fed that kind of concern. And I think given the starting gun on how the Fed started this easing cycle, I think it would take quite a lot for them to skip. So we're still in the camp that they do 25 basis points. But look, this is a huge change from where we were just a week ago. I mean, you mentioned the recalibration in markets. Well, I mean, the Fed's recalibrated its policy stance with its 50 basis point rate cut, and now markets are having to recalibrate their expectations of the U.S. economy, seemingly much more resilient than a lot of people felt. And I think this is going to put a little bit upside pressure on the dollar, at least in the near term.
James, you say it would take a lot for the Fed to not do another 25 plus another 25, but if we get strong inflation data Friday and we get more, jobs data in November that suggests the jobs market is still strong, then, what would maybe put a 50 back on the table?
To put another 50 basis point rate cut, you mean in the next meeting, or to deliver the 50?
Exactly, one of the next meetings having a 50 basis point cut, so 75 by year end.
Yeah, I mean, I think the labour market data have clearly improved, and so I think in order to go back to seeing the market price in a higher probability of another 50 basis point rate cut at one of the next 2 meetings, I think you would need to see, again, a renewed deterioration in the labour market. Essentially, that last week's employment report was a huge head fake, and that we go back to something what the kind of run of payrolls that we saw over the summer. I mean, over the summer, it was genuinely looking like there was a clear softening, and a lot of people were revising up their expectations of Fed rate cuts again through to the last 2 meetings, and we'll just need to go back to that narrative. But I think there's been so much data out in the last sort of couple of weeks which have really increased the odds of a soft/no landing. That I see that the probability of another 50 basis point rate cut has been pretty low. And it's not just the employment report itself from last week, but you also had jolts earlier in the week. You had very strong services ISM. Yeah. But for me, what was really important was the revisions to the household savings data in the week prior, where one of the arguments that a lot of people used to call for a hard landing in the U.S. economy was this idea that strong consumer spending may not be so long-lasting or sustainable because households were running down their savings. Well, guess what? That savings picture looks significantly better now and makes the consumer outlook much more rosy. So I think it's going to take a lot for the Fed to want to go another 50.
James, with all of that in mind, I look at the yen. It was the worst performing currency globally last week. I mean, down over 4%, the worst performance since 2009. Has the carry trade temporarily been relit, or will it be capped?
I think that's a good reason to think that it's coming back. I mean, you basically got carry trade survives off of low volatility. And yes, there is clearly some risk around volatility given tensions in the Middle East and so on, and the risk of oil prices associated with that. But the core in terms of like global growth is looking pretty good. I mean, you've got a much healthier U.S. economy, higher chances of a soft/low landing. A lot more stimulus coming out from China. I mean, compared to a few weeks ago, the global growth situation is looking pretty rosy. And yeah, I mean, you can use the yen as a funder in this environment where yields in the U.S. look unlikely to be heading significantly lower from here, where the Fed's going to be going at a steady pace. Like, I think there is good case for the carry trade to be coming back. Absolutely.
Moving from Japan to China, and of course it's going to be a big week in China, as you know, James. We have this quote from Goldman Sachs this morning. China equities, a further upside potential notwithstanding the powerful rally they have staged. We estimate a further 15 to 20%. Just want to move that over to the FX space, more your specialty. Do you see as well a movement in the Chinese offshore and onshore renminbi?
Yeah, I mean, I think the sentiment towards China had clearly become extremely negative given the performance of the data, and as we were approaching U.S. election, there was clearly some hedging going on, and people had a lot of long dollar exposure. And with the changes, then the rally in the onshore equity market, there's clearly a lot of catch up where offshore equity managers are having to reallocate their exposure. That clearly benefits the renminbi. We're expecting to see some fiscal stimulus being announced tomorrow from the NDRC agency. We'll see what that press conference brings, but we're expecting to see ultimately around 2 trillion renminbi worth of fiscal stimulus that pushes the GDP run rate closer to the government's target over the next couple of quarters. And yeah, that will help the renminbi. I do think that if you're looking to fund carry trades or in EM or looking to get long dollar, it's probably easier to fund that in yen, given that we have a stronger macro trajectory in China at the moment. But equally, like as we get closer to the US election, I do think people will start to wonder about whether or not the risks around the election are appropriately priced, and it might give some people a little bit of hesitancy to really gain CNH exposure just so close to the US election. So I'm feeling quite sort of neutral on the renminbi at the moment, really. And I think if you want to get back into some carry trades in EM, yen is probably a better option.
James, can we just square off very briefly on the election? We're counting down. It is getting closer and hotter. Hedging the dollar, the cost of that's at an 18-month high. A lot of people have written about a Trump dollar trade, inflation on steroids, the Fed on pause, and less rate cuts. But I hear very little written about the Harris dollar. Briefly, what would a Harris victory mean for the dollar?
Well, I mean, we think that a Harris presidency, our U.S. public policy team and has written quite a lot about this, is going to be more consistent with what you see as the status quo. So rather than thinking about specific policies of a Harris administration, it's more to us about what is the current cycle of the global economy. What would happen in markets if we just didn't have a US election and we just continued on the current trajectory? And the current trajectory at the moment is looking like US economy is going to have a soft landing, and at least relative to the Eurozone, growth differentials, monetary policy differentials look like they're sort of moving in a direction which suggests a stronger dollar, at least on a DXY basis. I mean, I think there is a lot to be said that risk appetite is quite well supported at the moment, and that's very good for emerging markets. And so, maybe you have a little bit of a sort of split dollar in terms of the performance, but and any EM longs may be better funded in things like euro and yen. But that's really the way I would think about Harris presidency, is just a sort of continuation of the cycle that we currently see.
James, thank you so much for joining us today. That is James Lord, head of FX for EM at Morgan Stanley. Now to other top stories trending on the terminal this morning. Boeing and its largest union are set to come back to the table to try and reach a compromise after 3 weeks of strike action. A federal mediator has summoned negotiators from both sides to discussions being held today, but the path forward remains unclear after Boeing's brash attempt to make a direct offer to workers failed 2 weeks ago.
Foxconn saw its revenue growth accelerate after it hit record sales for the third quarter. Also known as Honhai, the main manufacturer for Apple, saw a 20% surge in its sales, beating its own expectations thanks to its growing business supply servers with NVIDIA AI chips inside them.
And Rio Tinto has made an approach for Arcadium Lithium, according to statements from both sides. It's the latest takeover attempt by a large miner after BHP tried to buy Anglo American earlier this year. Shares in the smaller miner have halved this year as an oversupply of lithium and weaker EV demand has weighed on the industry broadly.
Coming up, it's been 1 year since Hamas attacked Israel, and Prime Minister Netanyahu vows to press on fighting.
The Israelis have not concluded what they're going to do in terms of a strike. That's under discussion. I think if I were in their shoes, I'd be thinking about other alternatives than striking oil fields.
That was President Biden at the news briefing for the first time in his presidency on Friday. Well, October 7th, today, marks 1 year since Hamas attacked Israel, with the nation bombing targets across Gaza now to prevent new threats from the terrorist group, according to the IDF. The Israeli army now saying 5 projectiles crossed into Israel from Gaza. Joining us is Bloomberg's Jumana Bersetchi from Dubai. So, Jumana, how do things stand 1 year on?
Yeah, well, it is a sober day across Israel and a really seminal event in the history of Israel, a game changer for how they view their security and defense within the region. And it has unlocked a series of events that we're still feeling the effects of today. After the unprecedented attacks from Hamas into Israel that killed 1,200 people, 250 people kidnapped, of which 100 are still in captivity, Israel launched very heavy military strikes against the Gaza enclave with the sole purpose of neutralizing Hamas and fully eliminating their military capabilities. Now, the death toll today is sitting very high. It's come at a very high cost. The Palestinian Health Ministry saying that 42,000 people have lost their lives, 90% of the population displaced, 60% of the city destroyed, and yet 100 of those hostages are still held in captivity with no real daylight appearing on these ceasefire discussions, and the political leader of Hamas, Yahya Sinwar, still alive, reportedly alive in Gaza. And of course, it doesn't just stop there. In the past couple of weeks, what we've seen is an intensification of the airstrikes in Lebanon, and there the stated aim is to eliminate Hezbollah's military capabilities, and that alongside those airstrikes, you've seen the beginning of a ground incursion into the southern part of the country. And then the third layer of the conflict, of course, is what is happening with Iran, because over the course of the last 12 months, there have been 2 direct attacks from Iran into Israel, the most recent of which happened about 5 days ago. And Israel is sitting now thinking about how they will possibly retaliate for those ballistic missiles that were fired towards Israel. So what you're seeing is a multi-front conflict being engaged from Israel against various proxies of Iran, of this so-called axis of resistance, be that Iran themselves, be it Hezbollah in Lebanon, be it Hamas within the Palestinian territories, and then the Houthi rebels in Yemen as well. So no sign at this point of the conflict de-escalating.
Jumana, we are seeing the oil market turn around, small losses. It's turned around and peaked right now. Again, we have a pivot from President Biden in the latter part of last week. Over the weekend, he said, I'd be thinking about other alternatives than striking oil fields. But still, there's a lack of belief that America, or indeed the Europeans, have a strong influence on this de-escalation.
Well, it certainly appears as though President Biden wanted to perhaps backtrack on some of the comments that were made towards the end of last week when he insinuated that one of the possibilities being discussed was a retaliation on Iran's oil infrastructure. And then, of course, he went on to give a press conference saying that they maybe could consider other targets as well. But at this point, it is unclear what Israel are going to go for, how the retaliation is going to come. But it seems as though diplomatic discussions are underway. And you will recall back in April, the first such incident when Israel did respond, it was a very targeted airstrike. They took out an air defense battery, and that was it. That was the end of it. I think this time around, the feeling from within Israel and Israeli intelligence officials is that the retaliation does have to be more potent than what they went for back in April. And therefore, that is why oil infrastructure is one of the methods that is being discussed. But they would want to do it in a way that would inflict harm on the Iranian economy, but not necessarily cause massive turmoil in global markets, which is the situation that they want to avoid. Oil experts say that one way they could do that is to target downstream assets. There's a refining capacity of about 500,000 barrels a day. Most of it goes for domestic consumption. If they did that, it would hit Iranian economy, but not necessarily the global markets.
Indeed, well, they're producing 3.4 million barrels at the moment. Jumana, thank you very much for the update. Jumana Basecci tracking the very latest on the Middle East, right here on Bloomberg. It's Bloomberg Brief. I'm Manus Craney alongside Vonnie Quinn. To the stock story at the moment, front page news. This is what we've got for you, making headlines around the world. First up, Washington Post. The threat grows that a dangerous hurricane could hit Florida's west coast. Storm Milton is forecast to continue rapidly intensifying before slamming into the state. The worst-case scenario projection sees this storm leading to more flooding in parts of Tampa. It could lead to some neighborhoods becoming uninhabitable.
Next up, Wall Street Journal. Putin's merchant of death is back in the arms business, this time selling to the Houthis. That's the Wall Street Journal this morning. Victor Bout has returned to work, brokering small arms sales to Yemen's Iran-backed militants. He was traded back to Moscow in exchange for a U.S. basketball star, if you'll remember. That was after 10 years in prison. And Bloomberg leads with Starboard Value has taken a $1 billion stake in Pfizer. Now, the activist investor has also approached the former Pfizer executives in an effort to spark a turnaround in the struggling pharma giant. That's according to Bloomberg sources. Joining us more on the story is Charlie Wells. So, Charlie, this is a $1 billion stake. It's a small stake, but, I mean, Pfizer was the darling of the COVID era. The stock is underperforming. Is this vaccine rise and fall story, is there more to it than just the waning vaccine story?
Yeah, I mean, Manus, at first blush, if you look at that stock chart, you will see a precipitous decline from that peak in late 2021, a 50% decline since that point. And so people look at this and they think, you know, Pfizer needs to find another hit. And they've been trying. They've been spending a lot on M&A. We think last year to that $43 billion purchase of Seagen, the cancer maker. So they're looking there, but they've had stumbles. So they've, you know, really been trying to plow into the obesity drug market. When they look around at the likes of, say, Novo Nordisk, they've got to be jealous about the returns that they're getting on those drugs, but they've stumbled in that search for the right obesity drug, and there is dissatisfaction among investors, at least according to people familiar with the matter, with the M&A strategy so far.
So, Charlie, what will Starboard try to do to turn Pfizer around?
Really striking here. So what a person familiar with the matter said is that Starboard approached former CEO Ian Reed, who led the company from, I believe it was the year 2009, I'm going to check my dates, to about 2018. Correct me on that. But interestingly, and Manus, this goes back to the point we were making earlier, this isn't just a story of a decline from, say, the middle of the pandemic to now. If you look at the share price from, say, 2009 to 2019, there was a rise of over 200% there. And so what we know about Reed, who a person familiar with the matter said has expressed interest in helping out here, we know that he was really focused on core, he was focused on vaccines, and he was focused on cancer. So we're not sure what the plans by this activist investor are now, but if they're tapping Reed, that could potentially be an indication of what they might want.
Fascinating. Charlie, thank you so much. Charlie Wells there in London for us on Pfizer. We do want to check bonds, though, because it's quite the turn of events. We have the 2-year and the 10-year both hovering at the 4% mark. Man, it's really insane when you look at this. Look at the 10-year yield above 4% now, and the 2-10 spread basically less than 1 basis point right now. As you can see, the 30-year is still at 427.30. So there's clearly more of a bid into bonds after Friday's jobs data, and as we go through the week and we wait for that inflation data. And of course, equity index futures in the United States at least are pointed lower as well. I do want to
absolutely, and sorry, Vonnie, go ahead.
Well, I was just going to show you on the terminal the chart that shows now that we're down to about 20 basis points of cuts for November and 45 of cuts for December. So we really are continuing to pull back those expectations.
Yeah, and I think this, what we've got here is rising bond yields. And again, that's just exerting a different kind of pressure on the equity market this morning, both 2s and 10s above that 4% level. Again, the market got to recalibrate this soft landing to no landing. What does that mean to the fat tails of inflation risk on either side? How do we prepare for a soft landing? That is one of the questions that we will put to our next guest. We're going to catch up with Cayla Seder from State Street in preparation for a no landing coming up next on Bloomberg.
From our global headquarters in New York, welcome to Bloomberg Brief. I'm Vonnie Quinn with Manus Carney in Dubai. Let's set your agenda.
Bracing for a no landing, short-end Treasury yields recalibrate the Fed's ability to deliver cuts. 1 year on, tensions mount in the Middle East as Israel ramps up strikes a year after Hamas's October the 7th attacks. And back to the table, Boeing and its largest labor union return to wage discussions after 2 weeks of stalemate. Vonnie, good morning. Bonds are on fire.
Bonds are on fire. We are seeing both the 10-year yield and the 2-year yield above 4% today for the first time since the beginning of August. It's not that far back, I guess, but you can see what kind of a rotation that we've had into and out of bonds. We're seeing back into bonds again with the 2-year yield at 399.31. We'll have to wait and see what the inflation data tells us this week. But certainly this is after the jobs data. And as we see geopolitical tensions continue to rise. For the S&P, we are looking at futures that are down about 0.6%. But remember, Friday, we did get a run-up of 0.9%. The record for the S&P is still 57.67, so we're really not that far off. And I want to point out that the VIX is above 21 as well, so there's a lot of volatility in this market. Not least in crude oil. If you look at New York crude, WTI at 76.15, that is quite the rise in just a few hours since it started trading on Sunday. Another 2.4% on top of the $5 plus that we got last week. It is October 7th, of course. That must be remembered. The latest job surprise, taking bets on another 50 basis points cut off the table for November. Let's have a quick look at where the jobs report came in on Friday to remind ourselves it was particularly strong and after a weaker 2 months. So we want to really dig in and see what this means for the economy and the Fed going forward. Joining us now is Cayla Seder, Macro Multi-Asset Strategist at State Street. So there are competing narratives today, Cayla, right? There's obviously the geopolitical tensions that continue to ramp up. We see that in oil markets. We see it potentially in bonds. And then there's the strength of the U.S. economy. So what takes any more cuts off the table for the rest of the year, as Ed Yardeni is saying this morning?
Good morning. Thanks so much for having me. So yeah, I think when we look at the labor market data, we're getting this message that the labor market is still strong. We still see lots of jobs being added to the economy. And so when we think about what that means for Fed policy, when we're looking at November, you have to ask, is 50 basis points really necessary? And so, I think we saw that reaction in the market on Friday where now we're down to less than 25 basis points total being priced in. And the question now turns, okay, do we need a cut in November or should we just be getting one cut? And so really looking at the agenda this week, we have CPI, and that should help add a little bit of clarity to the picture.
And the whole debate, Cayla, good morning to you, is whether we morph from soft landing to no landing, and no landing has an inflation dynamic to it, which of course then can reduce the overall destination, much less than 200 basis points if you go to no landing. How does that play out for equities? Do you invest in the tails of inflation, or do you just de-risk a little bit?
I think the big picture is we're still in a cutting and easing environment, and so that is still supportive of risk overall and still supportive of equities. However, I think when we look at where we want to be in the equity space, we still see a lot of upside for tech, especially because when we think about what would perhaps a no landing or even just a scenario where the Fed cuts less than expected, what would that look like? And so that means we could be in an environment where rates end up being higher than the market expects. And so what we've seen over the hiking cycle, or what we saw, is that tech held up very well. And so if you want to be allocated to areas where, okay, rates are maybe not falling as quickly as the market anticipates, we still like tech for that reason.
So, Cayla, you say the trade is pro-risk, pro-growth stocks, pro-tech, and so on, yet positioning is extended. Real money investors, they have an above-average historic allocation to equities. Do we need to bear that in mind?
Yeah, I think that's where volatility comes in. Because if we see volatility pick up, which we have been seeing intermittent bouts of volatility, you could see some signs of unwind. However, what we've seen so far when we see these intermittent bouts of volatility is that these unwinds don't last very long. And so, I think that means we have to buckle up and stick to our guns a little bit when it comes to tech. However, when you do want to look for opportunities to broaden out, which does make sense here, go to other quality parts of the market.
Well, Cayla, I'm looking at 2s, 10s at the moment in the curve. I know you're a fan of steepeners, but when I see shape-shifting like this, which is rolling over in the curve, is that a moment then to re-enter the steepeners that you are so bullish on?
Yeah, we saw a big move on Friday. And when we look forward from here, I do think it makes sense to look for some more signs of steepening, especially bear steepening on the long end of the curve. And so we will get auctions this week. That will help show a little bit around what demand looks like for the 10-year. But what we do see in our real money data set is that we do see a lack of demand for the 10-year relative to the 2-year. And so definitely keeping an eye on that.
Cayla, how much at State Street are you weighing what's going on with the US election, and how will that impact literally how you trade, the 1st of November versus, say, the 7th of November?
Yeah, I think, when it comes to fiscal policy, there's a lot of uncertainties out there. But one thing that does seem more certain is that there's a lack of impulse to curb the deficit. And so that really ties into some of our bear steepening ideas. When it comes to equities, it really depends on your volatility appetite. Usually we see volatility pick up pretty close to the election, and then it tends to die off. So when we look at our risk data, what we see is that markets aren't super tightly coupled. And so that's actually a good thing. That means that markets are less prone to a prolonged risk sell-off. And so if you're able to sit through a little bit of volatility on the other end, I think things will be calmer on the other side of the election. So.
Well, certainly there's a disruption in these markets at the moment. One thing is important is earnings. If we look at the earnings outlook for the third quarter, we're going to get BlackRock, JP Morgan, a couple of airlines this week. So we're going to get into the third quarter. Earnings estimates have dropped to just sub 5% from over almost 8%. But that's still a strong innings on the earnings front for you for the third quarter, isn't it?
Yeah, and it's not abnormal to see earnings expectations revise lower heading into reporting season. So the fact that we're seeing revisions lower isn't super surprising here. I would say when we're thinking about earnings, again, it comes back to the higher quality, more profitable parts of the market. I think last quarter, especially with Q2 reports, we saw exodus out of the tech space a little bit because of concerns around earnings, how long earnings could hang on for. And so I think these revisions actually help a little bit with the market getting more in line with reality. But again, as you point out, those expectations are still strong. So, we think earnings look pretty good from here.
Okay, reality is not a bad place to check into every now and then. Cayla, thank you very much. Cayla Seder there of State Street joining us this Monday morning. Context matters every day on Bloomberg.
President Trump must win to preserve the Constitution. He must win to preserve democracy in America. This is a must-win situation. Must win. So I have one ask for everyone in the audience, everyone who watches this video, everyone in the live stream. This one request is very important. Register to vote.
The world's richest man, Elon Musk, on stage with Donald Trump at Butler, Pennsylvania, where the former president returned over the weekend after having been shot there just 3 months ago. Joining us now from Washington is our Bloomberg government reporter, Jack Fitzpatrick. Jack, when you look at the presentation on stage, it was powerful imagery that Elon evoked at the home of the brave. So this emboldens the MAGA base. But what does it do? Does it resonate beyond that is the question.
It doesn't seem like it was meant to resonate beyond Trump's base. In fact, you heard Elon Musk, you saw him jump up and down and say that not only was he MAGA, he's dark MAGA. They made comments, the two of them, about how if Trump does not win this election, it will be the last election in the U.S. This was meant to amp up the rhetoric and play up the stakes of the debate of the election to Trump's supporters. If there is a serious attempt to win over people who are on the fence, to win over moderates, it seems to be happening elsewhere. The Trump rallies are really aimed at ramping up the base and keeping people engaged, which is largely Trump's strategy, and bringing Elon Musk out only played into that same strategy.
Jack, Kamala Harris's 60 Minutes interview on CBS airs tonight. Now, Donald Trump refused to sit down for one himself, but let's have a listen to what the vice president had to say.
The work that we do diplomatically with the leadership of Israel is an ongoing pursuit around making clear our principles, which include the need for humanitarian aid, the need for this war to end, the need for a deal to be done, which would release the hostages and create a ceasefire.
Jack, how is Harris marking the 1 year since Hamas's October 7th attacks?
Well, both candidates have fairly straightforward commemoration events. Harris is planting a tree in commemoration on the grounds of the vice presidential residence. Trump is meeting with Jewish community leaders at one of his hotels in Miami. I think the quote there from Harris shows that she has a tougher needle to thread. She says in this, the preview of the 60 Minutes interview, that there is an important alliance between the American people and the Israeli people. But as you see, she needs to emphasize that her administration would also push for an end to the war, try to push Netanyahu into allowing more humanitarian aid. That's a more nuanced or more complex position than the Republican position, which is really hitting Democrats, saying they haven't been steadfast enough in their support for Israel and not tough enough on Iran and its proxies. So that's a hint of how she comes at this issue.
Jack, we have to leave it there. Thank you so much. That is Jack Fitzpatrick of Bloomberg Government. Staying in Washington, though, President Biden made a surprise appearance at Friday's news conference where he spoke about Israel's plans for retaliation.
The Israelis have not concluded what they're going to do in terms of a strike. That's under discussion. I think if I were in their shoes, I'd be thinking about other alternatives than striking oil fields.
Joining us now is Bloomberg's Bobby Ghosh. Bobby, today is obviously 1 year since the October 7th attacks. I'm curious as to how much more we know now about what might happen today. Iranian airspace reopened, for example, so perhaps Iran isn't expecting anything today?
Well, I think that would be foolish to write off Israel at this point. Israel has shown that once it has announced that it wants to do something, it has a tendency to deliver. The nature of the Israeli strike on Iran is unknown. We heard the president there saying he hopes that it's not on oil facilities. But Iran is a target-rich environment. There's lots of different targets that Israel can aim for. There's plenty of military targets. There's plenty of civilian infrastructure that does not necessarily include oil fields. There are oil refineries, for instance, which would hurt the Iranian economy and the Iranian regime domestically without really affecting necessarily the price of oil internationally. So there are plenty of options, and I wouldn't rule out an Israeli response. Netanyahu has said there will be one, and he would look weak if he does not deliver on that threat.
Bobby, good morning. We now have hot conflict on multiple fronts. As you said, we await the Iranian response. We await the Israeli response on Iran. But if I was to say to you, are we any clearer on what the end destination is for Netanyahu? He's a politician now who's a little bit more emboldened domestically at home, so he has a little bit more of a wind behind him domestically than he had maybe a couple of weeks ago.
Well, he's a prime minister. He's a leader of a country, the government that is now fighting 3 wars, 2 land wars, one in the south against Hamas, one in the north against Hezbollah, as well as essentially an air war against Iran. And that's a pretty awkward position to be in. At the moment, the land wars are going very well. What we haven't heard 1 year on, what we haven't heard, what the Biden administration keeps asking for and has not yet heard, is what happens after this? What is the ultimate goal? The Israelis, Netanyahu himself, only talks in terms of destroying the enemy. Well, there's a whole discussion to be had over whether Hamas and Hezbollah are the kind of enemy that can actually be destroyed. They've certainly been greatly degraded. But then what happens in Gaza on the day after? What happens in Lebanon on the day after? As we know from wars throughout history, wars only really end when there is a political dimension, when there's a political aftermath that has been clearly defined. And there's no trace at all of that kind of a definition. And that has been a matter of frustration for the Biden administration, but that has also been a matter of anxiety for the whole region. There are many people in the Arab world that will look kindly upon Israel attacking Iran, that may not mourn the death of the leadership of Hezbollah, but even they want to know what comes after this, how to prevent this endless cycle of conflict, a period of calm, and then conflict again, how to break that cycle. We don't have any articulation from Netanyahu or any of the Israeli leadership about that.
Bobby, Iran is a $380 billion economy. Israel is a $500 billion economy. Obviously, huge populations in Israel, but 9 times that in Iran. Is there a point at which this war on many fronts becomes untenable for Israel, or indeed is there a point at which Iran cannot continue to spend on defense and even offensive strategies?
Well, for Israel, the crucial question is American support and American backing, and it has that, and unambiguously and clearly for the duration. Whatever the Biden administration says, there is an unflinching commitment to supporting Israel militarily. You hear from the vice president, you hear from everybody in the administration, Israel has a right to defend itself. We'll continue to give Israel what it needs to defend itself. So as long as Israel has America's back, militarily as well as diplomatically, I think it can continue this fight really for quite a long time, despite the disparity in the size between Israel and Iran. And not just Iran, consider the whole of the network of Iranian proxies all over the region. Israel still has military superiority over all of them collectively. So as long as it has America providing substantial defense, Israel will feel that it can keep fighting.
And that is the risk here in the region, is that the escalation goes to the Strait of Hormuz. And that's something which has been flagged. That flag has been raised from various parts of the Iranian side. Bobby, thank you very much. Bobby Ghosh on the very latest conflicts. Let's get back to the bond markets. It's just gone 5:49 a.m. in New York. You're looking at, again, quite a stunning move into your notes over the past 2 sessions. You're looking at nearly 28 basis points of a spike in twos. We made it over 4%. That's for the first time there since August the 23rd. You've got 10s also trading briefly above the 4% level for the first time since the 8th of August, as these bond markets and yields reprice to a no-landing scenario from the Fed, and the possibility of a rate cut in November is dissipating. The market now pricing less than a full 25 basis point cut in November. Bonds are bid. Let's turn our back, or the yields, I should say, are bid up. Let's turn back to stocks. Now, we've got Boeing and the union there. They're set to return to the negotiating table after 2 weeks of stalemate. Workers are still holding out for better pay and pensions. Let's bring in Benedict Kamel. He's tracking the story for us. Benny, look, there's been very little movement in the past 2 weeks. The same issues for the company hold, which is junk status, cash flow. But are the unions under any more pressure as their workers are, it's getting harder for them to perhaps stay on strike?
Good morning. Yes, we were actually talking to some of the striking workers on the picket lines in the last couple of days, and the mood does seem to remain relatively upbeat. People are saying, let's hold the line. We're in this for the long haul if we have to. We've made the savings. We can make ends meet by other means. The gig economy might provide some outlet for people looking to sort of prop up their money. So there does seem to be a sense on the union side, now is the time to fight. This is as good as an opportunity as we're ever going to get. Boeing is weakened, so we are potentially in a better situation here. And it's sort of that dynamic with which they're coming back to the negotiation table. You said rightly just now, 2 weeks of very little movement, and finally they're coming back today to the table. It might be a quick resolution. It might drag out. It's really too soon to say at this point. Wages are the big sticking point, but also pensions. Boeing has offered 30%. The unions would like to see something closer to 40%. So they're not that far apart on that in that regard. But the pensions, that is a real red line for Boeing to reinstate those. So that might drag out.
All right, Benny, thank you so much for joining us today with that update on Boeing, returning to the table with its labour union. Benedict Kamel there. Coming up, we'll get you set for this week, including the CPI report, and of course, big banks start to report their earnings. Context Matters on Bloomberg. This is Bloomberg Brief. I'm Vonnie Quinn in New York, along with Manus Cranny in Dubai. Now let's take a look at what's ahead this week. Well, we're going to hear from the Fed's Bowman, Kashkari, Bostic and Muslim. That all starts at 1 p.m. Eastern today. Then, of course, we get the latest readings on inflation coming in on Thursday and, of course, Friday. Plus, JP Morgan and Wells Fargo kicking off earnings season for the big banks on Friday.
Bonnie, let's check in on some of the individual names that are on the move. Pfizer activist Starboard coming in with $1 billion stake in Pfizer. Investors seek to turn around a lagging pharmaceutical giant. On the bid front, Arcadium Lithium, Rio Tinto makes a takeover approach. So a little bit of moves on both, but Arcadium up the most. Look, we also need to just remind ourselves, Vonnie, that we've got $69 billion worth of auctions coming down the pike this week. And we just caught up with State Street and they said, look, the appetite is going to be a little bit tougher on the 10s than it is on the 2s. And again, that goes back to the no landing and the risk of inflation 2025. So it's a big week for the bond auctions.
Huge. And Manus, look at that. We're less than a basis point now in terms of the 2s-10s spread. It's been, a long time since we've seen that kind of spread between the 2s and the 10-year. 398.48 versus 399.64. It should be a few interesting sessions this week.
It will indeed. I'm in Dubai for the next couple of days. We're joined at the hip. We're counting down to CPI and the FOMC minutes. Context Matters every day on Bloomberg.